Much of the markets are focused on President Trump's aggressive tariff strategy, with a temporary pause offering some signs of relief. To break it down further, we are joined today by Kyle Rodda from Capital.com. Good to see you. Market's got a 90-day pause on the new tariffs. How significant is that for investor sentiment?
Very significant for investment sentiment, especially initially. We saw that, really quite remarkable rally a couple of days ago on Wall Street, the largest we've seen basically since the global financial crisis, which perhaps tells you a little bit about the level of uncertainty in the markets right now. But if you look at what happened last night, we did see a fairly significant drop for a couple of reasons. One, I think there is the sobering reality that although things aren't as bad as expected initially, we still have 145% tariff rate being applied on China now, and that was a detail that was kind of almost missed by the administration and failed to be communicated by the administration. It was picked up by the markets last night and confirmed subsequently by the Trump administration. A huge number. So there's that element to it, and there's of course this uncertainty whether these this pause will result in any kind of deals being struck by the US and its trading partners, and to what extent there's been permanent damage done in terms of the confidence amongst investors as well as economic participants in the US government and US assets. So still a very wild ride. There was the relief rally. Again, things could have been much worse. However, there is the simple fact of the matter that the tariffs on China, as well as a 10% tariff across the board on other trading partners, is still very negative for global growth, still very negative for the stock market.
Yeah, absolutely. And of course, a market that's gasping for air. But a 145% tariff rate on Chinese goods sounds extreme. How are markets pricing that in?
Well, increasingly now, and it'll be interesting to see how we trade today because the news only really developed last night. And again, it was because of a memo released by the White House, and that had to subsequently be confirmed by the media that the Trump administration effectively said, yes, the tariff rate isn't 145%, isn't 125%, as we've been speaking about over the last few days and had been more or less, announced by the Trump administration. But it's actually this 145% rate, which is absolutely extraordinary and does all but kill trade between the two largest economies in the world. So, we haven't seen the market retest the lows just yet, that we did see at the start of the week when everyone was quite scared that, Trump was going to push the economy off the cliff and not back down on any of his tariffs at all. But still, there needs to be, the market still needs to fully price in the impact of the tariffs that are going to be applied on China. Obviously, there's reciprocal tariffs that China is applying as well. And it just says to me that this volatility isn't over yet.
Yeah, absolutely. So with US inflation coming in lower than expected, is this opening the door to Fed rate cuts in any way, shape or form?
Yeah, at the margin, it is. I mean, the Fed and Fed speakers have been, fairly careful about not over-promising. It has to be said over the last week or so, Chairperson Jerome Powell on Friday more or less highlighted that, while there are significant risks to the downside for economic activity, they're very cognizant that these tariffs will cause some kind of a price shock, if only transitory. And he did use that word a few weeks ago, actually, in his press conference in relation to tariffs. They're kind of suggesting that they're going to sort of wait and see. The data last night showed that inflation, core inflation in particular, came in at a 4-year low at about 2.8%. And that is more or less suggesting that, okay, the tariffs are going to cause a potential spike in prices, certainly a slowdown in economic growth. Maybe the Fed has a little bit of extra wiggle room to be able to lower interest rates, because inflation is looking like it's coming up under control, before these tariffs are applied. And there are hopes now that the Fed will be cutting as soon as June. So still very uncertain because we don't know what the impacts are going to be on growth and prices from these tariffs. But at least it looks like going into the application of these tariffs, inflation was moving in a direction that allows the Fed, again, a little bit of room to maneuver.
Okay, so how might Trump's tariffs clash with the Fed's monetary policy goals? They shred to coincide, but can they coexist?
Well, I mean, the president wants to find a way for them to coexist, and we've already seen him on several occasions kind of goading the Fed to cut interest rates as the tariffs are applied. But, as we were just sort of noting then, effectively we're running into a bit of a catch-22 potentially for the US Federal Reserve, that the tariffs are going to slow economic activity, possibly and probably lift unemployment at least a little bit, at the same time that there is a price spike and the risk that, like in the 1970s, a supply shock leads to an unanchoring of inflation expectations, and that rate cuts could potentially send inflation in the wrong direction. So the Fed's wanting to tread very, very cautiously here. If nothing else, rather than maybe a pause or a hike in interest rates coming down the pipe because of these tariffs, it might just delay the Fed in cutting interest rates until they have the confidence that they're not going to actually stoke inflation. The markets think they'll cut soon. They don't seem to be worried about it, but there is a risk that that could happen, and that could shake things up a little bit as well, because obviously at the moment, the markets are really hoping the Fed can at least pad the markets, ease the sting to the economy from Trump's tariffs.
Kyle, US banks are kicking off earnings season. How are they positioned amid these trade tensions and everything we've been discussing so far?
Yeah, we'll get a bit of a canary in the coal mine look at what's happening in the US economy. Going forward, more or less, will be the interesting element, just because the situation has changed so significantly in the last 2 weeks since the end of the quarter, that a lot of the results that we get from companies are very, very backward looking and won't take into account the tariffs and the hit to, say, margins, as well as investment decisions and all of and capex decisions as well for some of those tech companies that the tariffs will have. So I mean, what I would suspect is that maybe less so from the banks, but certainly from some of the other companies that are going to report. The banks are a bit of an unofficial start to the earnings season in the United States, that will get the removal of guidance, or at least some downgrades to guidance, as corporates struggle to deal with the uncertainty associated with the trade policy. So, it could potentially be a fairly negative earnings season, not necessarily because of the results of the last quarter, but because of, if nothing else, the lack of clarity that the corporates can provide the markets because of this uncertainty, or even outright downgrades to earnings guidance because of the hit that they expect tariffs to have on their bottom lines.
So Kyle, just to round out our discussion for today, overall, are markets more focused on Trump's trade agenda or macroeconomic signals like inflation and earnings as well?
It all starts with the trade policy and goes from there. So all of those things are important, but effectively markets are trying to gauge what the impact of this trade policy will be, and then subsequently price in what the earnings outlook is and what it might mean for growth and inflation. So it's very difficult to move trade policy from the centre of things at the moment because it's really driving everything else.
Yeah, absolutely well said. And of course, thank you for joining us on the program. Look forward to speaking again right here on Ticker.
Thank you.